All right, now that we have officially ended the first quarter of 2012, big question right now for investors is, will the economic rally in the U.S. that's carried us through another wave of European debt scares and China slowdowns, is it going to be enough to carry us through the second quarter? Some investors not quite so sure. Joining us right now on the fundamentals, we have James Swanson, Chief Investment Strategist at MFS Investment Management. Also on the technical side, our guest host for today, Michael Gayed. You know where he stands, everyone. He's talking about a market that could be up 40% by year end. I want to kick it over to Jim for a moment. Jim, I know you've been feeling better about the U.S. recently, and you feel that the equity market could be well positioned, but there's some headwinds out there, aren't there?
Yeah, and there's a dark shadows come over this party, and it's a big one. We've studied this, and the causes of recession are really basically three. One of the big causes is energy shocks. When you have a 2% gobbling up of disposable income of the ultimate final demand in this country, which is the consumer, they thrive on gasoline. That's how they get to work. When you have a 2% gobbling up, which is roughly what we've had, and it's sustained, you go into a downward consumption spiral, and that worries me. If I'm the pilot of this ship, I've got green check marks everywhere, profits, corporate cash, you name it, except this energy problem. We've got to get some relief soon, and that's why I'm worried about the second quarter for the market.
So, Jim, what you're really saying is high gasoline is such a problem that it actually chokes away other consumption. Is that right?
Yeah, and it seems to be a threshold effect, and we've seen this multiple times. Go back 74, 78, in the mid-'80s. We saw it in 91. We saw it in June of '08 before the public knew anything about Bear Stearns, Lehman, and AIG. It was real consumption started to dive bomb in June of '08. That's when we hit crude at 140 and gas at the pump at 418 then. So it's kind of worse, and we're getting close. We're not there yet, but we're getting close.
Michael, our Uber bull, you're shaking your head yes, a little bit of an agreement there. So is this the big headwind?
With a caveat. So rising energy prices, I would actually argue, if the speed is gradual, can be bullish for equities because that could increase cost-push inflation expectations, which would in turn push money out of bonds into stocks. Again, the spring switch idea. If the move is spiky, if you have an overnight jump in energy costs, that's more deflationary, that's more slow growth, recession causing. So I think what's missing partially in this discussion is the speed at which energy prices rise. And one last thing here, the reality is equity markets worldwide have risen by about $5 trillion. The consumer can absorb higher energy costs as long as the stock market itself continues its advance.
Well, I mean, that may assume there's some sort of wealth effect. In other words, as stocks go up, you feel wealthier, so you're willing to spend higher or more money on gasoline. Stephen Schork of the Schork Group has done a lot of work on this, Michael. He comments that you get gasoline above 4, 4.25, and to Jim's point, you choke off demand. So I need for you to help me understand, because I'm not feeling the love right now, why higher oil is somehow going to be okay if it's a gradual move.
If it's a gradual move, the idea is that it will push money out of bonds and into risk, which is equities.
But that's an investment argument. That's not necessarily a guy on Main Street. The guy on Main Street may not even have money to put into the stock market. I mean, he's just trying to fill his gas tank, or she.
I'll grant you that. What I'm arguing is that there's a flow of funds reason for why you could have money be pushed out of bonds if rising energy prices are perceived gradually as rising. It's inflationary, right? So that's the key point here, the speed at which energy costs move. If gas goes above $4 or $5, but the Dow is at 20,000, it's okay.
Yeah, that's a good point.
Dow
We've been talking about this
okay.
quite a bit on the show. I mean, Jim, I'll give you some background. This week we were just debating, is it the tail that wags the dog or the dog wagging the tail? In other words, energy moving higher is sometimes seen as a bullish sign for the markets because it's suggesting that people are willing to pay more, that there's more global demand for energy, and that the economy can take it, so to speak. You don't think the economy can take it?
No, that's where the mystery is. That's where the problem is. You've nailed it, because demand has been falling for several months. And in fact, miles driven in the U.S. is below where it was in 2007, the previous economic peak. So this is not demand driven out of the biggest chunk of consumption in the world, which is the U.S. consumer. And it's not coming out of EM land because they're slowing down. So this is a supply side shock, and no one seems to be able to identify it. That's what has me spooked.
All right. Might some of this be because some of the, we learned this week, the Iranian production is down about 300,000 barrels per day. Is that part of it?
I think it's part of it, and I think it's speculation that some country, and you know there's only one or two that are thinking about this, has to do something with Iran's nuclear production operation before the end of the year. There is that notion out there. There are a lot of articles about this that have access to these three leaders. It seems to be there's speculation that something's got to happen, and Iran has promised reprisals if anyone does that. So I think it's a geopolitical supply shock, and that isn't indicative of the economy all getting better and everyone getting richer. It's an exogenous shock that's worse than a tax increase.
Okay, so then what does it mean for your investment horizon right now? Jim, how are you playing this? You buying energy?
Well, no, I'm not, because supply shocks can go very, very quickly. I am really a fan of tech. I think tech is changing the way we live. The valuations are interesting, 3 product revolutions, and it's changing the world, and no one seems to be paying attention to that sector right now. So that's where I would be.
Well, and you've
it's not going to get you out of an energy mess, but...
But it's one place you can make money, one of the best performing groups of the quarter. Talk to us about free cash flow and profit margins within tech. That's part of the story, isn't it?
Absolutely. Free cash flow margins in tech land. Just take an arbitrary 10-year comparison. We're triple what we were 10 years ago. These companies are making money. They have no balance sheet risk in the sense that they're not indebted. They've got very clean, pristine balance sheets. Second most leveraged to international growth, kind of an implied call option on the growth of the Chinese consumer. And yet there's all this deferred spend by corporations in the U.S. The age of software in the U.S., installed software is the oldest ever. So the tech sector has a lot of things coming toward it.
But hey, you're also worried about oil. Why not buy oil? Oil prices potentially going up. Hedge your bets. Why not do that, Jim? Hey, Michael, are you doing that?
You know why I'm not doing it? Because the implied price of crude in the stocks that are trading out there is like $85. The stock market seems to be saying oil's going to come down because the demand isn't there for it.
Michael?
That's why I'm not buying it.
Yeah, and actually, I agree that oil prices probably would decline. If you assume that this entire move up was because of this fear about a military conflict in Iran, then why aren't defense companies outperforming the S&P? There seems to be within the stock market a bet that we're going to avoid that conflict. If that's the case, the fear premium in oil likely has to come out, which means energy stocks continue to likely underperform.
Well, if that's the case, then that would actually bode well for the U.S. consumer, would bode well for the economy, and therefore would bode well for the stock market. But I know, Jim, you don't necessarily agree with that. Unfortunately, we're going to have to... What?
It's so hard when you're trying to deal with leaders of governments and how they're going to react. I mean, that is part of this equation. I hear you. I totally agree with you. If we get a relief trade in oil, which I think the market's kind of expecting now, that's why energy stocks are so low. We get that relief trade, the economy will do better, and you'll want to be back in the stock market. But why risk it here with these kind of metrics going up at the gas pump?
All right, we're leaving it there. Thank you so much, Jim Swanson. A pleasure to see you from MFS Investment Management.